应该是错过了。
All right, everybody. Thanks for coming. This is the third and last quant seminar of the semester, and our focus this semester has been on sort of fintech and of various nature. So we started with machine learning, then we went into blockchain, and sort of now we're at robo trading. So we kind of like to keep our eye on all these fresh new topics. So I'm very happy to have Adam Grealish from Betterment with us today, and he's going to tell us a little bit about these automated methods for investment, and many of our students will be familiar with portfolio optimization problems, but it seems like today you were going to have a focus on tax implications, but possibly give us an overview as well of what robo trading is about. Thanks for coming, and I'm very much looking forward to the talk.
Thank you. Thanks for having me here. Just a quick show of hands. I'm curious how many people have heard of Betterment before this kind of came up. So, okay, maybe like 20, 30%, maybe 40 for being generous. Well, just to tell you a little bit about what Betterment is, we're an automated online advising platform. We take a goal-based approach to investment management. And our goal ultimately is to use technology to deliver higher returns to our customers through basically automating optimal investment strategies. It's worth noting that Betterment's probably most known for its direct-to-customer business, where people like you or I could invest. We also have a white-labeled technology platform for financial advisors and a 401k business. So we're spanning 3 different lines of business. So just a really quick background. The term that Betterment often gets lumped into, it's been popularized across the press, is the term robo-advisor. And I found one definition that describes it as robo-advisor provides financial advice or investment management online with moderate to minimal human intervention. They provide digital financial advice based on mathematical rules or algorithms executed by software. I'd say that's a pretty accurate description. So we're doing both financial planning and investment management. It can be completely hands-off. You don't have to talk to a human ever. We also have human advisors on the ready for people who are interested in delving a little bit more. And we are, by nature, because this is being deployed through software, it's all based on algorithms based in math. So I'd say that's a pretty accurate description. And if I had to sum up kind of what Betterment's doing in one graph, that's perhaps a little bit nerdy, it would be this one. This is simulations that we ran of our portfolio management strategy versus more naive portfolio management strategy, and the IRRs of this strategy over time. You can see that this distribution is shifted to the right of a more naive strategy, and I'll go in through the rest of this talk. It's kind of discussing how we go about doing that, but the broad overview is by keeping costs low, by offering a diversified global portfolio, doing tax optimization, and encouraging good investor behavior. So a little insight into how we think about investing here at Betterment, and the way, I'll try to walk over here as well a little bit, not to ignore you all. One way that we think about investing that I would say is a little bit different than what you'll probably hear at most investment management companies if they're giving you their pitch. And that's, we like to think about where we spend our effort in terms of how deterministic it is and getting a good outcome for investors. So and we can think about this as a hierarchy, as things that we do that will definitely help you achieve your financial goals, to some that are much more probabilistic in nature. So down at the bottom is keeping costs low. So the more money you have in your account, the more likely you are to reach your goals. The second is taxes. If you do certain tax strategies, at the end of the day, you will end up with more money after tax after you've paid Uncle Sam. The third is trading, kind of in two ways. One, keeping costs low in trading. It's a, kind of goes part and parcel with costs low overall. And then secondarily, if you can trade in a more intelligent way, perhaps there's some alpha to be extracted there. And then the last two that are the least deterministic in terms of your reaching your investment outcomes are security selection and asset allocation. So it's really hard to say that I think Japan is going to outperform the US over the next 6 months, year, whatever time horizon you might say. It's equally pretty difficult to say I think this fund is going to outperform that fund. What you'll find interesting is that when most asset managers are talking about things, they end up talking about the top two and spend little to no time on the bottom three. And we tend to think about it in the opposite direction, spending most of our efforts thinking about the things that are going to be most deterministic in investor outcomes. Of course, we spend a lot of time thinking about allocation and selection. We'll go over that in detail here, but it's worth thinking about the whole picture and how they fit together. So jumping right into kind of the first piece of automating a personal investing equation, that's risk management and rebalancing. So before we get into that, we should probably take a quick step and talk about how we get to our portfolio overall. So we start with a globally optimized portfolio. This is probably what it looks like across all different risk levels from 0% stock to 100. We're achieving this in a Black-Litterman optimization using robust optimization techniques. So I kind of figured everyone here is somewhat familiar with that, so I didn't dive too much into that, but happy to field any questions. And actually later on in the talk, we'll show a little bit of how we're harnessing the Black-Litterman framework with views to think about taxable investing and expressing after-tax returns in that framework. So the resulting Betterment portfolio, this is something probably everyone's seen a million times, the efficient frontier. You can see in blue our efficient frontier for all of our portfolios. Plotted in gray are just randomly constructed portfolios inside the efficient frontier, select assets inside the efficient frontier, and 80-20 US portfolio. So we're pushing out on the efficient frontier by optimizing across asset classes across the globe. So we have an idea of 101 portfolios that we can possibly choose from 0% stocks to 100. That's our menu of stock options that stock portfolio options that we can choose from. The next step is we help you choose exactly how much risk to be taking based off of your specific investment goal and the time horizon around that goal. So this is a screen you'll see inside the app where we give you advice on how much risk you should be taking. We're advising, in this case, 63% stock risk. We give some projections about what that might look like over time. And from there, we have your allocation set. From there, that's when kind of the computers take over, perhaps, so to speak. So how we're managing your target weights through daily monitoring with our platform. So we're doing this across close to 500,000 customers, and not every customer has one goal. Some have multiple goals, so it's closer to 600,000 or 800,000 individual portfolios that we're monitoring on a daily basis. And we're doing two things. We're monitoring how far they've drifted from their target allocations, and secondarily, we're looking for places to rebalance tax efficiently with cash flows. So that's anything from when we are taking fees out of the account to when dividends hit the account. I'll talk a little bit later about some selling we might do with tax strategies and using that as a tax efficient way to rebalance as well. So we think about rebalancing first and foremost as a risk management tool. That's the reason why it exists overall. But we also view it as contributing in a small way to generating alpha. And this is an interesting paper in the Journal of Wealth Management from Bushi 2012 that talks about holding two securities that are growing through time that are uncorrelated with each other, and rebalancing will actually give you a better outcome than holding the security that grew the most over that time period. This is just taken directly from that paper where it's showing what happens if you were to buy and hold all Apple versus if you had held Apple and Starbucks. Because this is a mathier group, this is how he decomposes that growth to help you think about it. So starting with just a compound growth equation where we have average return of the portfolio mu minus the drag from volatility. So that's the growth of $1. You can decompose that into the growth of the portfolio, where the first term is, again, the weighted growth of the portfolio, but then we're exploding out the portfolio volatility, and you can see that the two pieces here are the average variance of the portfolio and the portfolio variance. So as long as two things are growing and they're uncorrelated with one another, it presents the opportunity to rebalance and extract additional value out of that portfolio. So an additional piece that we're thinking about in the rebalancing equation. So the second thing is that risk profiles generally need to change over time as the investor is evolving through the life cycle of their goal. So we are giving advice on that, and also if customers turn on the feature, we'll do that for them. So the first thing to think about, I mentioned earlier, is that the risk level that we recommend will vary by goal type and horizon. And what I mean by goal type is actually something fairly specific. It's more or less how you plan on using that money when your goal term is up. And two very specific examples, a major purchase goal. Say I want to put a down payment on a house in 5 years. Well, I'm going to invest for 5 years, and at 5 years I'm taking all that money out to put the down payment on the house. Versus retirement goal. Say I want to retire in 5 years. Well, once I hit that 5-year goal, I'm then taking out a small amount of money from that account over the next, say, 30 years of my life. So the liquidation profile is one of the main pieces that we're thinking about in differentiating goals. And given that liquidation profile, we're then building out a glide path based on how long your horizon is. So like you can see here, we have the major purchase glide path on top. You can see that as we're getting close to the end of your investing term, you're basically entirely in cash and like low risk bonds. Whereas in retirement, when you hit your retirement at say 65, you're still 55% invested in stocks, right? Because you got a while to go. You still, the last dollars you might spend might be 30 years from now. So that's a little insight into how we think about the advice. Then we do this for you. So if you were to do this on your own, you might revisit your allocation, say once a year. That seems like a prudent way to go about it. In the meantime, you have all your money moving towards that particular allocation, sort of a stepwise function. We're adjusting this on a monthly basis, and that does two things. One, when we're moving your target allocation, that means every marginal dollar going in is pushing you closer to your target allocation, as opposed to, it gets pretty extreme. At the end, I would be putting all my money into this portfolio, and then the next day I would be, have way too much risk, right? So it creates an opportunity for cash flows to get you much closer to the correct risk target without potentially having to do a rebalancing trade where you sell things to de-risk. So before I move on to the next topic, I guess I'll just stop there for a second and check in with any questions. We'll have time at the end to chat as well, but before moving on to the next topic, I wanted to stop there for a sec, see if anyone had any questions.
Since you are using Black Betterment as your optimization tool, how do you ensure that you are doing accurate estimation of the covariance among assets, because there are many of them?
Yeah, so we do a couple things. The first is we are doing our Black Betterment optimization with broad asset classes, right? So we're doing this with U.S. stocks, international stocks, EM stocks, and their bond counterparts in those regions. So we have very broad, somewhat fairly mutually exclusive asset classes with long histories. So that's kind of step one. Step two is we're employing robust optimization procedures around our covariance matrix. So we're taking long histories of monthly returns data and using robust covariance estimation techniques to try to get a more stable covariance matrix.
So it's not individual assets, it's more like ETFs or that represent these risk.
So great question. So super broadly, when we think about our asset allocation, our strategic asset allocation, we're thinking at the asset class level. We're thinking about broad market cap based asset classes like the broad U.S. stock market, the broad international stock market. And that's what we're doing our optimization on. From there, we're actually expressing those positions with funds. We have to select funds, which is the next step with ETFs. So our portfolios are entirely based on broad market cap based ETFs. So the idea here is we have an optimization where we're trying to optimize our exposure to risky asset classes that we think have risk premium associated with them. And then from there, we're trying to get exposure to those asset classes as cheaply as possible through ETFs.
Is there an optimal time interval to rebalance?
Yeah, that's a great question. So we've done a decent amount of thinking about this, and the way that our rebalancing algorithm works is not time-based at all, but trigger-based. So we're measuring the drift from your target allocation, and once it gets too far away, we're going to rebalance. So, time is somewhat an arbitrary construct here. What we care about is managing risk. So it does, in a time when there's a lot of market dislocations and market movement, we're going to be rebalancing more frequently. If markets are calm, we could go years without rebalancing, right? So, yeah, that's a great question.
So you were saying earlier that portfolio managers are not really talking too much of cost versus tax versus trading. Is that what's your educated explanation of the reason they're doing that versus you guys doing this?
Yeah, I mean, honestly, I think most of the reason is most of the stuff you're reading is for institutional investors, and institutional investors don't think much about taxes. If you're talking to a good financial advisor, they're going to be thinking about this quite a bit. And I think there's a big disconnect between people who know a lot about finance, who might work at a hedge fund or so on and so forth, and knowing a lot about personal finance and that part of the equation. In part of our 401k business, we have some hedge funds on our platform, and we'll go in and talk, and oftentimes they'll know a lot about the security piece, but a little bit less about the individual investor piece of it. So I think that's part of it. A lot of what you read tends to be geared more towards someone solving an institutional investing problem.
So institutions tend to pay sort of less tax in that sense. So
Yeah, it's just a different tax regime than like individual investors. So, yeah. Yeah.
For the personal investment, the transaction cost or trading cost right now has been dropped a lot.
Yep.
Coming to zero.
Mm-hmm.
What are the remaining costs still that we need to offer?
Yeah, so fees on ETFs have continued to go down and down and down, right? So that's been a great thing, and Betterment has been well positioned to take advantage of that. So one real distinction between Betterment and a lot of other robo-advisors is that we're independent. We're not tied to an individual fund family, right? So like Schwab has a robo-advisor, Vanguard has a robo-advisor, and these are basically distribution platforms for their own funds, right? Whereas we're running, this is a great segue, from your question, I'm going to segue into the next topic. We run a quarterly fund selection process where we look at the entire investable universe of ETFs and rank them not only on their expense ratio, but the other factors that one should consider when thinking about investing in an ETF. The one that I'll point out is tracking errors becoming increasingly interesting to look at in a world where the fees on the funds are going to zero. So, and then trading costs have started to go to zero as well. So that's another piece of the equation. Yep. So yeah, great. Moving on to fund selection. So as I mentioned before, we are doing this quarterly as part of our investment committee review. We're starting with the entire investable universe of ETFs, filtering out ones that don't meet our criteria in terms of getting broad exposure to the asset classes we're interested in. And then ultimately we score them, rank them, and then there's a kind of a systematic step where we're doing this, and then a human step at the end where we see the short list and consider any other external factors that might be. So this is kind of what our filtering step looks like. It's it's kind of whittling down the number of ETFs. And this is our sorting criteria. So what we ultimately care about is the total annual cost of ownership, or something that we sometimes call TACO, the TACO score, which has two component parts. The cost to hold, what you incur every year as an investor for holding this fund. Expense ratio is usually the biggest part of this, but also tracking error, tracking difference is the other big piece. And this is how closely does it track the index that it says to be tracking. So this is where you capture all the other things that could cause the fund to perform well or not versus an index, how well they trade, what they do at their securities lending. So these are two ways that funds can not charge an expense ratio and still make money, right? They can trade poorly or get paid to send their order flow somewhere. And they can also run a securities lending program and pocket some of the money they make from that, as opposed to plowing it all back to the benefit of the shareholders in the fund. So cost to hold. Cost to trade, this is the liquidity piece. This is in-house market impact model that's considering average bid-ask spread and volume or liquidity in the name. So we're considering that piece as well. And this is kind of a look under the hood. Like, this is part of the report that gets generated. So this is for broad U.S. stocks. You can see we're looking at expense ratio, the spread. We we think about ADV, we roll it up into a cost of trade number, we're looking at tracking difference, and then the taco score. So you can see that VTI, Vanguard's total U.S. stock market funds on top, and that's our primary name in the portfolio. And this process results in keeping costs very low. So the overall cost of our portfolio ranges from 6 basis points to 17, depending on what risk level you're in. Yeah, so that's kind of the last step there. I'll stop for a second and take any other questions before we move on to perhaps everyone's favorite topic, taxes.
I have a question about the life cycle issue. Do you take into account people who think of part of their capital as permanent, multi-generational capital, so that you don't have this issue of shifting over time, fully invested?
Right. Yep. That's a great question. So the answer, the short answer is no. We don't have like a bequest goal. Might be what you're thinking about. That's something that we've thought about in the past, right? It's a good idea. The way that someone could still use that is ultimately give recommendations on where your asset allocation should be, but you can always change it, right? We could tell you, hey, listen, like we think you should be in a 50% stock portfolio, and you go, this isn't for me, this is for my kids. Like my time horizon's actually 50 years out, so I'm gonna change it. But yeah, definitely an innovation would be creating a separate goal for bequest. Yeah, absolutely.
So we already predict the future return of your portfolio. What the simulator did you use to generate the future returns?
Yeah. So we're generating our capital market assumptions, so our particularly expected returns from the reverse optimization from CAPM, right? So we take our robust covariance matrix and we take the market portfolio. And then we reverse back out what expected returns look like from those two inputs. So that drives our expected returns. And then generally, when we're looking at a strategy, we have a Monte Carlo simulation engine that operates at the tax lot level, so we can test our tax strategies to give us an idea of how a portfolio would perform and how any new innovations or tweaks to a portfolio or portfolio strategy might perform. Yep.
Have you given any thoughts to replacing the ETFs with individual securities, or is that thought to be too expensive a process?
No, it's definitely on the short list of things that we think about, right? So I broadly think about it as a way to kind of disintermediate the fund industry, right? So in theory, there's nothing stopping us from just holding, the 1,000 largest securities in the U.S. and saving a couple basis points, right? So in reality, there's a lot of operational costs associated with that. So it's not as simple as snapping your fingers, but it is an interesting thing to consider. One, because it unlocks a little bit more of a tax harvesting opportunity, and two, it adds another dimension for personalization, right? So, someone who just can't hold something because they work somewhere or they just have preferences for or against certain companies. But yeah, it's a great question. Yeah.
So you list each individual cost, right, as bits.
Yep.
And then you have a total cost. It's sort of addition and subtraction of those few ones, or it's more complicated?
Yeah, so this is the very stylized version of this. The way that we weight these is, it's like a linear combination of these. So cost to hold, we think about, basically it's the expected cost to hold through a year. I like to think about it as a bit of a Bayesian problem where like I have a strong prior that it's going to cost the expense ratio, and I want to update that prior based off of what I observe around tracking difference. No extra pieces to consider. You should just underperform your index you're tracking by your expense ratio, right? It turns out to be a bit noisier than that in practice, but that's the way we think about that piece. And then cost to trade, Yeah, we have a internal market impact model, and then the way we combine these two terms is we basically take the expected amortized turnover of a customer and weigh that in, because people are trading a lot. People are trading a lot less than once a year. Our turnover is less than once a year, so we would need to weigh these pieces together. So, yeah.
What's the average size of the portfolio?
The average balance at Betterment is about $40,000. So we have about 20 billion in AUM and close to half a million customers. So
What's the median?
what's the median? That is a good question. I don't know it off the top of my head. Yeah. But it's probably skewed to the left. Yeah. All right, great. Thank you for those questions. That was awesome. Managing taxes. So, yeah, as a retail investor, taxes are a huge consideration. Taxes can cost anywhere from 0.5% to 2% of a drag on annual returns, depending on your portfolio turnover, tax bracket, and other considerations. It also presents one of the best opportunities to outperform and differentiate in the retail investing space. And to be honest, it's substantially easier than beating the market. So let's dive into it. We do this with three main strategies: tax loss harvesting, asset location, and lot sorting. Go into each one of those in a bit more detail, starting with tax loss harvesting. So tax loss harvesting is selling securities at a loss to realize that capital loss for tax purposes. And then you generally, in a tax loss harvesting strategy, are going to buy correlated security to keep your market exposure the same. So the goal is to basically keep your portfolio as similar as possible while capturing losses. And here's why capturing losses is good. You get to defer capital gains. You can shift short-term gains to long-term gains in certain cases. One important thing is that you can take $3,000 of losses and rate them off against taxable income, which is a nice piece. And then for any losses that you've accrued that you haven't used, netting against other gains or reducing your taxable income, you can just continue carrying them forward to future years. And it can result in permanent tax avoidance in certain situations like bequest or charitable donations. So here's a basic example of how it works. Say I bought, this is EM ticker VWO. Say I bought some shares with the basis of $5,000. It may have gone down to 4,700, something like that. I sell VWO. I realize that tax loss, and then I buy an alternate ticker that's also giving me exposure to EM stocks. Just to set up this problem a little more formally for the group, we want to maximize the losses harvested within a tax year while maintaining our target risk allocations. We're looking for opportunities to harvest daily, and we want to determine when to harvest versus the wash sale lockout period. So I'll talk a little more about that in a second. We also want to avoid wash sales. So what's this wash sale constraint? So wash sales end up being a pretty big constraint in this process. The IRS basically says, hey, you can't just sell this and buy it back, right? You can't just churn your portfolio. I can't own Coke, it goes down, I sell Coke and buy it back 4 seconds later. The IRS is like, hey, I see what you're doing here. You're just, running up losses. And they define that as a substantially identical security, which they've never ruled on what that actually means. At Betterment, we interpret that as meaning as long as you're not following, the ETF isn't following the same underlying index, that they're different enough. Some would argue that's an overly conservative interpretation. If they're just different securities, that might be enough, but that's where our legal team landed. And you can't purchase that security 30 days, up to 30 days after you sold it, or 30 days before. So you can't buy it ahead of time you couldn't say, okay, I own Coke at a loss. I'm going to buy more of it, and then I'm going to sell the depreciated shares, right? So there's a 30-day window before or after where it's considered a wash sale if you buy something similar. So one way we solve this is by using alternate tickers that I mentioned that track different indices. So that allows us to put inflows into a secondary security. One thing you want to avoid, though, is blindly switching back into the primary after 30 days. This can actually increase your tax liability. The simple example here is I've held something for a while, and then it goes down, so I can realize a long-term capital loss, say of $1 a share, and then I buy a secondary, and then it just rips up over the next 30 days. It is up $4. And then I blindly sell my secondary security to buy back into the primary security. I've now realized $1 in long-term losses, but then $4 in short-term capital gains. So this is like negative tax arbitrage. So we really want to avoid that. Well, that's the example I just talked about. Another thing to consider is that the qualified dividends only kick in. The qualified dividend lower tax rate only kicks in after 60 days period. So another thing to think about as well. So there's all these things of just churning back into the primary really quickly can hurt your tax efficiency. And here's an example. So this is a back test we ran where if you did TLH with an automatic 30-day switchback versus staying in the secondary. So you can see that that switchback in the times when you can have negative tax alpha really drags on your the annual offset that you pick up. So this is how much tax loss as a percent of your portfolio you've picked up in the strategy. So choice of the secondary is important. It obviously should have a high correlation to the primary security, comparable fees, sufficient liquidity. So when we're running our total annual cost of ownership analysis, we're doing it for primaries and then also secondary and tertiary tickers. So we want to be comfortable that if we're in the secondary, we're okay being in that for the long haul. So the second question comes up of when do I choose to actually harvest? So this is like a fairly non-trivial question because after I choose to harvest, I'm now blocked for 30 days from doing anything else. So ultimately, what happens if the security continues to go down? Well, there's like opportunity cost in that. I harvested too early, right? Setting a threshold, we have to consider two things. The expected benefit of harvesting should be greater than the transaction cost of doing it, and then the opportunity cost, since we can't harvest for 30 days afterwards. So considering the transaction costs for very low volatility assets, we're just generally not going to end up TLHing. But the second problem is a little more interesting, and we can borrow options theory to kind of help us parse it. So harvesting a loss is similar to writing a 30-day put struck at the harvest price of the security. If you think about the payoff diagram, if the security continues going down, then it's a negative payout for us. Here's the hockey stick graph, right? So harvest price, the security keeps going down in price. We're worse off than we could be, right? So what does that mean? We can kind of structure this as an options problem in a way. So we want to harvest when the basis minus the price, the harvest amount is greater than the value of a put struck at that price with the time over the next 30 days. And like the big thing to pull out of this is that volatility is kind of the biggest driver here. Where we're trying to set our harvesting triggers. So for securities with lots of volatility, we could guess that we're going to want to have a larger threshold before we want to harvest. Putting this all together, this is a back test of what annual offsets or annual harvest amounts as a percent of the portfolio look like through time. We end up getting offsets 11 out of 14 years. Annual offset was close to 2%. There are no negative offsets over the period through no negative tax alpha, which you can, if you're allowing risk management to be your primary driver, you can potentially, still end up doing that a little bit. And then the back-tested results ultimately are showing that TLH is driving after-tax alpha. So this is actually applying those losses through time and then liquidating the portfolio. At the end of the liquidation period, we have to pay some tax, so it eats into the overall benefit. You don't just pocket the whole loss at some point. You eventually have to pay some tax. The main advantage of TLH is 2, writing off some against your ordinary income, and 2, deferring taxes and growing that deferred tax amount. So kind of to cap off, some innovations in tax loss harvesting, or if you're thinking about this for your personal account and don't want Betterment to do it for you, is you want to stay in your secondary after your harvest. Don't blindly switch back. Your decision to harvest should consider transaction costs and also the opportunity cost of future wash sales. So that means that your decision to harvest should be conditional on the volatility of the asset. You should rebalance with each asset, with each harvest. So I sell something, I now have cash. You don't necessarily need to just buy all of the secondary. This should go into your standard rebalancing equation. You're immediately going to be pretty underweight the thing you just sold, so you're probably going to buy a lot of that. But you might also be buying some other underweight assets. You want to consider all beneficial accounts. So if you're married, that includes your spousal accounts. So you can't be so clever as to you sell the security and your wife buys it back. That the IRS has caught on to that. And then something that, honestly, if people really want to get into it, we can chat about it offline. But there's some special rules around IRA accounts, where if you realize a wash sale in an IRA account, that loss is permanently disallowed, which is like a very bad thing. So we want to avoid any wash sales in IRA accounts. And that's why we have IRAs and 401k accounts. So that's why we have a tertiary ticker that makes sure we're never washing anything. The tertiary ticker only lives in IRAs and 401ks, and it makes sure if we're trying to buy an asset class, and if we were to buy the primary security, we would end up with a wash sale. We buy the tertiary instead to avoid that. And then we're continuously monitoring this every trading day.
What assets are these rules applied to?
Sorry, which assets?
What asset classes, yeah. Are these individual stocks or anything?
These are the rules. These apply to all securities that I'm aware of. The IRS rules on it?
No, I mean, what asset classes do you apply
Oh,
to
do we
our
do this?
portfolios? Yeah.
Yeah, all our asset classes except for the super short duration bonds that just don't move around a lot. So, but the majority of the action's happening in the stock ETFs, right? Great. Yeah. So the next strategy to employ is something called asset location, which can broadly be thought of as putting tax inefficient investments, bonds, in tax efficient accounts, IRAs and 401ks. So certain assets are more tax inefficient than others. Bonds are tax inefficient. International stocks that aren't getting qualified dividend treatment. Of course, accounts have different tax treatment. Roth and traditional IRAs and taxable accounts are kind of the 3 that we have to play with. Setting up the problem here, we want to allocate our assets across all these accounts to maximize our after-tax return, subject to we preserve our target allocation, our portfolio, and the account balances are preserved, because you can't, if I have 10K in my IRA, I can't, and that's the most that I'm allowed, I can't just add another $1,000 to it if I'm maxed out, right? So there's hard constraints there. So we have to respect the balances that are there, and we have to respect the risk of the portfolio and the target weights. So just a quick overview of tax treatments for security types. Two things to think about is the dividends, which happen annually. Things that are taxed at an ordinary rate are most bonds and foreign stock that doesn't get qualified dividend treatment. Preferential rate are most domestic stocks. They get qualified dividend tax treatment. And then municipal bonds have no tax on the dividends. And then capital gains if you sell something. So ordinary rate, securities, short-term capital gains, anything held less than a year. Preferred rate, securities held for more than a year, long-term capital gains. And then no tax is if you're transferring to a charity or on death to your estate. Okay, so non-tax located looks like how we might create a naive portfolio. We say, I have 3 accounts. I don't know, I want 70% stocks in each, so each gets 70% stocks. Got it, that was pretty easy to understand. But you can still keep that 70% allocation, but move things around such that the inefficient stuff is in the efficient accounts. So in this case, blue are bonds and green is stocks. So we can see that we're moving almost all of the blue into tax advantaged accounts, with the exception of one. And does anybody have a guess what that one bond that we leave in the taxable account might be?
Munis.
Munis, yeah, exactly. So, and yeah, so this is a process that that can be optimized. We can set this up as a mathematical problem, right? Some things to consider in doing so. One thing that's great about setting things up as mathematical problems, automating them, is it forces you to think about all the inputs to the problem and how they interrelate with one another. So the simple way to do this is to say, are you a bond? You go in the other account, right? That would be like the simple heuristic way of doing it. But if you're trying to get a computer to do this, you might want to think a little more deeply about it. So going beyond rules of thumb, one, we want to consider the growth rate of the assets, because if I have a Roth account in play, this money can come out, right, tax-free. I get taxed on the front end and not on the back end. So if something's growing faster, I want to put it in that account. So considering the growth rate of the asset and the dividend yield, considering part and parcel with that is considering the tax drag from dividends and the dividend yield, and considering the liquidation taxes, and then also considering QDI ratios. So not all dividends from stocks are the same. And this is kind of setting up that problem. We chose to set it up as a linear programming problem, but ultimately it's setting up the exact same problem that we set out before, where we're looking to maximize the expected after-tax return, R times X, subject to constraints that enforce our balances across accounts and enforce our limited draw from our target allocation. So yeah, just to sum up this one, how is it different or better? We're considering the annual taxes that you incur and liquidation taxes. We consider qualified dividends, consider the growth rates on assets, and then we're solving this problem basically constantly for people who have this feature turned on, where any money that's coming in, we are putting it through this problem and trying to constantly asset locate them in a more tax efficient way, trying to constantly maximize their after-tax return. And so what does this look like? We ran this through our Monte Carlo simulation that I talked through before, and we see it's adding about 50 basis points a year annualized of return to a strategy that's not employing this. So, this is a good example of something that you do, you just end up, you're doing things that you just end up in a better spot at the end by doing some of these tax strategies. And finally, tax lot management. So one interesting thing is that if you go to your brokerage and tell them you want to sell a security, the IRS mandates that by default they use Fifo lot sorting, which is first in, first out. So that means the share of Apple you bought 10 years ago is the one that they sell, not the one you bought yesterday. So that basically, by nature, almost always guarantees that you're selecting the lot that has the most appreciation in it, which is the opposite of what we want to be doing. So you can also tell your broker exactly which lots you want to sell, but you have to actually tell them. At Betterment, we're doing this for you. So we have a lot management program where we are sorting, whenever there's a sell for a security, we're sorting all your lots and we're selling the biggest losses first and selling those down. And then once we're on to gains, we're selling the smallest gains first and so on. So, yep. And just a reminder, losses are useful. You can net them against capital gains, write them off against income, carry them forward. And then finally, thinking a little bit about managing tax rate uncertainty. So one thing that's a little bit challenging about doing this is tax rules can change underfoot. How do we think about this, particularly in the case of how we're selecting our allocation, our allocation to more tax efficient versus less tax efficient securities, right? So the example I'll give talks about munis. We know munis are more tax efficient, but we don't know what rates are. In order to figure out the after-tax return, we need to know tax rates, right? And those tax rates might change through time. So how do we kind of address that? So we address tax rate uncertainty through our Black Litterman process. So we incorporate after-tax outperformance as a view in Black Litterman. It allows us to specify a level of confidence around it and to add one more level of robustness around that. We're also doing a robust optimization on our posterior returns. So how are we doing this? Let's see. We're just we're adding in the after-tax performance view. We're adding in uncertainty into that matrix. This is a better slide. So yeah, we take our prior expectation of return that comes from backing out the CFEM model, and then we're putting relative tax efficiency as our view. We're giving it a confidence level, and then working that through to get our posterior distribution. Once we have our posterior distribution, we're doing a robust optimization on that. So we're drawing from our joint posterior distribution. We're constructing an optimal portfolio out of that. We repeat that hundreds of times. Well, we write down what that optimal portfolio looks like. We repeat that hundreds of times, and then we average across those to give us some more robust coefficients that are a little less sensitive to specific capital market assumptions.
How often do you do that per portfolio?
So we're revisiting our capital market assumptions and our kind of strategic asset allocation on roughly an annual basis. We have a strategic portfolio. We don't have tactical views on one thing versus the other. So, generally an annual cadence is right to just incorporate changes in covariance, structure, and so on. And, the most meaningful difference here is incorporated in muni bonds. So muni bonds have meaningfully better expected after-tax performance in a taxable account. So this is the increased allocation to muni. This is the weight in muni bonds compared to our IRA portfolio. So our IRA portfolio is not taxed. Muni bonds don't make it in, but you can see they make it in up to 20% weight in our taxable portfolio. So this is the result of that process. Okay, and then finally, I think we have 6 or 7 minutes left. Is that, Sasha, is that right? Yeah. To go over the last topic, which is behavior, which is pretty interesting and pretty interesting topic, but I'll pause for 1 second just to see if there's any questions on the tax piece. Yeah.
So I'm not sure whether every company is the same, but our company only allow us to invest limited number of choices in our 401k account. So we still use your tool.
Sorry.
So basically, we couldn't allow, the company couldn't allow us to invest all the ETFs available on the market in our tax saving account. So I guess we couldn't do this kind of optimization. Maybe also we couldn't invest on everything.
So you couldn't do this because?
Because the company only allow us to invest limited number of assets in our tax saving account.
Okay. So it didn't allow you to do asset location because you were?
Yeah. There's some limitation on the ETFs that we can invest in.
Yeah.
Our account.
Yeah.
So will that affect us to use your tool?
Yeah. I mean if you have fewer assets, you're going to have less harvesting opportunities. It's just kind of you're piling on constraints, right? Like there's a limited universe, like if there's limited accounts. Interestingly, for someone even who's just using a 401k, if they have the access to Roth and traditional, if they have assets in both, they can do some asset location between Roth and traditional 401ks or Roth and traditional IRAs. So that's one place that you can also do asset location.
So with robo-advising, as I understand it, it's more for passive management and not as much as active management. So do you see that as a limitation, especially in the light of tax loss harvesting, that it has to be a lot of qualitative analysis that needs to be done?
Well, so I guess there's a few things I'd say about that. One is, I mean, you can see here there's a lot of active things going on, even though we're investing in market cap weighted securities, right? We spend obviously a lot less time constructing views on which securities or regions or all the number of ways you can make bets, which ones are going to pan out better. That said, like this kind of platform works with active investments. We recently partnered with Dimensional Fund Advisors, which is a well-known systematic active shop, to get their funds on our platform. We also have a smart beta portfolio where, so this is kind of active or active light funds. So we're allowing these funds to produce some alpha in that respect while still benefiting from the platform that is managing risk, is rebalancing, is doing tax strategies and so on. Cool. So I'll jump into behavior, and then we have some time at the end to field any other questions. So one of the biggest things that hurts retail investors is themselves. They tend to invest. They tend to sell when after the market has dropped and buy after the market's gone up. We'll go over a little bit. There's some studies that try to quantify exactly how much that is. So there's a number of things that we're doing, including setting smart defaults, automating as much as we can, using investor biases against one another to get to better behavior. There's an example of that in here, and also just generally being goal-based in general tends to help. If you know this money's earmarked for 30 years out, it's a little less scary when there's a 10% drop. So first is fighting market timing. So investors, it's a well-known fact that investors underperform a buy and hold strategy. There's been a number of papers on it that estimate anywhere from 1% to 4% of annualized underperformance from just investor behavior and trading too much. One of the most famous papers is called "Trading is Hazardous to Your Health," hazardous to your wealth. So that's a good title. So we find at Betterment that a minority of our customers market time. So there is still some, but about 3/4 of the accounts are not market timing, are not engaging in bad investing behavior, and those that do, the gap tends to be lower. So we look at this pretty closely to try to make sure that customers are doing the right thing with their money on our platform. One thing that we found is that there's a monotonic relationship between the number of unnecessary allocation changes that they're making and the negative drag on performance. So here's some stuff that we're doing to try to combat that. One is as subtle as just how we use certain colors. So our use of the color red is very intentional and very different than what you might see in a stock trading app, where stock trading apps make money by you trading more. So they're incentivized in their design to have you trade a lot. You can see a very different design patterns at Betterment, where we don't care how much you trade. We just want to build your wealth, right? So you can see here, I picked a period where there's negative returns in the app. There's no red here. Where there is red is where you're off track to meet your goal. And the difference here is that when you're off track to meet your goal, there's things you can do about it. So the main call to action here is to open a goal forecaster, which is this screen. And this helps you figure out how you can get yourself back on track. You can set up a recurring monthly deposit. You can set up a one-time deposit. You can change the time period of your goal. So these are things that you can do to actually change the status and get yourself out of that red state. Also, times of downturn are obviously a time when there's more unrest amongst investors, and certainly amongst our customer base, like any. And one thing that we do here that I think is very different from a traditional financial advisor is we have a platform where we're generating tons of data, and we're able to run tests. We're able to analyze that data, run tests on it, and see what happens to improve investor outcomes. That's something that the average human advisor really is not set up to do, and certainly not set up to do at this scale. So one thing that we tested was long ago in our history was, okay, the market's down. Well, what do advisors usually do? They reach out to their clients. So let's send our whole client base a thoughtful email saying, hey, like, don't worry, the market's down, but you're in it for the long haul, so on and so forth. The outcome of that email was horrendous. It caused people to log in, to de-risk, to pull money out, so on and so forth. So what did we learn from that? We learned that most people were blissfully unaware that anything was going on in the market whatsoever, and we sent them this email to alarm them. So the first thing that we learned was concern about the market should happen where people are seeing the concern in app. So they come to the app, market is down. They might have heard that the market was down, but they go in app to see how it's actually affecting them. That's where the first thing we learned is have the interventions there. And second, we have a platform now to, once they're in app, we have a platform to test different messaging and understand how it works, understanding if an intervention in app helps or doesn't help. And these are some of the results from one of that, from, as you can see, a little while ago. So what we were measuring is a series of what we consider negative outcomes. So did they defund their account? Did they change their allocation? Did they withdraw? And positive, did they deposit? And you can see that a notification decreased all the bad things and increased the one good thing at the So there's more detail in this that's not on the slide, but we tested different messages, and we generally found that any of the messages, any treatment tended to move things in these ways, and different ones were more or less
So
effective.
how is the deposit growth related to you alarming them that they're not on track, which would naturally happen if the market goes down?
So, sorry, what's how are they
So-
related?
So on the previous picture,
Yep.
right?
Yep,
Their portfolio was going down.
yep,
They are off target now.
right,
You alarm them about that.
yep.
They make a deposit. You're basically collecting much higher fee.
Yeah, I see what you're saying. You're
Which
saying,
is, again, you're stimulating them to buy low, right?
Yeah.
Low,
Yeah.
not high, but
yep.
you're,
You're
your
saying,
power
yeah, you're
now
saying,
is
yeah, I see what you're
you're
saying.
generating revenue by that. How isn't there an ethical?
Yeah,
Here's the balance.
I mean, like,
Ethical and
yeah. No, it's a good question. Like, I mean, in terms of incentive, like, we're incentivized to gather AUM, right? To grow the AUM that's
course.
there and to gather it, right? I would say that, like, on the margin, like, a cynical interpretation would be that, yeah, that's what it's doing.
cynical or
Maybe,
realistic?
or realistic.
Practical.
Yeah, so, I would say that this only switches over for people who are in a bad state, who are close to who are on the margin anyway, right? So there's people who are off target and will continue to be off target. There's people who are on target and have enough buffer that if it goes down, that they'll still be on target. So it is a narrow band of people who are kind of, on the precipice. Like, that is to say, I think if our goal were to extract, to gather more assets, there's probably better ways to do it than, like, get the narrow slice of people who happen to be, like, just on the razor's edge of being on track or off track. And the motivate, two ways to do it is through savings and deposit. One is by changing your goal plan. Another that we move to a different screen is changing your allocation. You can take more risk in certain cases that might help you, right? So, there's a couple of levers to pull, but, generally one of the biggest problems in financial planning is people are not saving enough. So while it's helping get assets onto Betterment's platform, generally one of the biggest problems is people are not saving enough for retirement. People are not saving enough for these things. So, yeah, but, your point is, like, I hear what you're saying, yeah.
How often do people log into the platform without any alerts or alarms?
It's the distribution is very, it's like very skewed, right? Like, so there's, a medium-sized group of people that are logging in at least once a week, and then there's a long tail of people who aren't logging in for months or even years. So, yeah. Okay. And then I think this might be the last piece, and then hand it over to you guys for questions. That is one of my favorites, is that we're pitting biases against one another. So people hate taxes. And people hate taxes almost in an irrational way. Some people are almost willing to pay $2 to avoid $1 of taxes in taxes. People also get very scared when the market is changing and want to fiddle with the allocation. So one feature that we have is before you finalize an allocation change, we surface something called Tax Impact Preview, which shows you in the moment before you complete your transaction what our estimation of your taxes are for doing this transaction. So it does two things. One, it takes information that you almost certainly should know before you make the decision whether to transact, and it gives it to you right at the moment where you make the decision. So that's really helpful. But secondarily, it has this effect of people just say, taxes, I didn't know that was part of the equation, just abandon completely, whether or not this was a good call for them or not. And we see it's fairly effective. So this is the completion rate of people who are looking to make an allocation change. And we see that when we show them an estimate of taxes, versus no estimate, it's down. And not only that, as the size of the tax estimate increases, the completion rate drops off precipitously. So kind of an interesting case of one, surfacing valuable information at the moment when it's useful, but secondarily, there's a little bit of behavioral thing going on here where people are repelled by taxes and just abandon the process completely. So that's it. Thank you for listening to the talk, and we're doing questions till 7:30 or
7:25, but thank you very much.
Okay.
Let's have 5 minutes of questions if anybody has questions.
Yeah, I guess people list robo-advisor as one of the top application area of AI in finance.
Yeah.
I think, obviously there are other areas, but I mean, how much intelligence you see actually in this, and how big actually those tons of AI methods out there have actually put into this.
Yeah, it's an area that we continue to look into, and I honestly think some of the first places that we'll see AI is in the robo-advising and fintech space is in probably not like the headline things that you would expect, but automating some of the peripheral and I guess peripheral pieces. Like, for example, one problem that we have where we have some AI technology is people will aggregate, will link an external account like a 401k. And sometimes we don't know, like it's not a publicly traded security, but we know properties about that security. Like, for example, its name might be U.S. stock fund, and it might have other characteristics with it. We can't map it to a ticker and understand what it's like, but we can take the information we have about it and try to use some, AI or machine learning to map it to things that we do know about and find a proxy ticker for it. So that's one area. Another area is Betterment is moving into kind of the cash management space, checking, savings, more people's everyday financial lives, which gives us a wealth of transaction data on their everyday lives, right? Everyday spending habits, and it's a rich data set to build more complex models for advising people of how much cash they should have in their checking, identifying when they should be moving cash from a checking account to a savings, from a savings to an investing account. So, those are a few areas that kind of are, I'd say, a little bit tangential to core investing problems and the use of AI there. So, I mean, that's how some of the way that we've been thinking about it recently.
So if I invest through Betterment, do I still need to file my own tax return?
You do have to file your own tax return, yes. That's something that we've considered, though, is more becoming a tax preparer as well, right? That would be, it's kind of a natural step, right? And a lot of the super high-end financial advisors, they will either do that or work closely with. So, broadly, I think about Betterment's long-term vision as kind of twofold. One, putting a financial advisor at the center of everyone's financial life. If you think about the center of most people's financial lives, it's a bank whose job is to basically extract fees and build value for shareholders. Whereas if you think about how the very wealthy, if you ask who the center of their financial relationship, it's a financial advisor who they're paying to do the best thing for them. Often they have a fiduciary relationship. So part of Betterment's longer term goal is to put a fiduciary, an advisor, at the center of everyone's financial life. Secondly is kind of borrowing from that, like what ways can we take technology to make things that previously were just done by ultra high net worth and institutional investors and make them broadly available. And that's where tax preparation could come in.
So your treatment of tax seems to be very important.
I'm guessing most of this is just federal, U.S. federal.
Yeah.
Is there any move to individualize, or is that too much change going on?
Yeah, it makes the problem space a much more complex, right? Just in the set of amount of rules to manage. One kind of off menu item at Betterment is if you call in and ask for a state muni instead of national muni fund, we have that option available for New York and California. But it's just not, it's a challenging option to scale. And then also, interestingly, if you look at the after-tax yields on state munis versus national, it's not always obvious that being in the state is the best one. So, and that's something, that's why it's not on the menu, is because we don't monitor that. Like that, that we, it's something that we could add to a roadmap and add, but that's also why it's a little bit of like a off-menu item. But yeah.
Is real estate property or any real estate related, like rates or any other security types part of your asset class?
So REITs are incorporated just through holding broad equities. So broad equity indices hold REITs and market cap weight. So that's how real estate gets in that specific way, but not in any other way. For people who have other real estate holdings, you can link external accounts and also add in a manual. So if you have a house that's like a big part of your net worth, and you might use, you can use Betterment to display and track your net worth, you might want to put that in there. But it's kind of a manual process right now. Yeah.
So let's say if I invested in a real estate fund.
Yeah.
Can Betterment provide like a risk return sort of view for that type of investment?
At a very high level, but yeah.
Does tax treatment affect even your construction of your investment universe at the SA level as well? Like, if there's a high yield in there even at all, maybe for like an income investor? Like, do you start thinking about taxes all the way up at like,
No, not at that level. We also have an income portfolio, which does that we've built in partnership with BlackRock. That does move. It's an entirely bond portfolio, so it is moving the lever on credit quality. So, yeah, broadly, we're thinking about asset classes. So it doesn't really come in at that high level.
for asset location, right?
Yeah, exactly. So it doesn't come in, like, we're not precluding an asset class simply for tax reasons. Yeah.
So robo investment is getting more and more popular. So what is Betterment doing to be unique to do?
Yeah. So I would say there's two things. I mean, there's a lot of it's in this presentation. Very few robo-advisors are doing all the stuff that we're thinking about. But, at a head, like, also very few people come to a presentation and try to understand each one of these pieces. So, like, more headline level, I'd say there's two things. One is our structure being an independent robo-advisor as opposed to being just a distribution arm for other fund companies. So that aligns us with customers in a way that is different from many others. And the second is pushing further into people's financial lives, into their everyday transactions, banking, checking. So that's a big piece for us as well, is becoming a more full-service financial advisor in some ways. And you can imagine that trend continuing in all the different dimensions that you can imagine through time.
For the platform and the AI implementation, have you used any AWS or Azure APIs, or you using custom internal stuff?
So,
and what's your observation if you have used any of the kind of public?
Yeah, so we run a lot of stuff on AWS. AI specific, not a lot. We run AWS for just a lot of our more computationally intensive research things, like our Monte Carlo simulations are on AWS. Some of the back tests around. So we'll build a model, like perhaps more complicated cash flow model, and then we'll back test it on AWS. Yeah, I mean, we're like a moderate user of AWS from research purpose, and then I'm the wrong person to ask about this, but our technology infrastructure, I think, sits on AWS.
I'm interested in, are there some efficiencies? So for example, if I have an account and I have a certain portfolio and I buy something and someone else with another portfolio is selling something, is there some netting of trading, or is everyone's account their own little island on its own?
Yep. Yeah, so this is a great question. So like order flow internalization, can we just, you're buying, I'm selling, can we just strike it at market mid and never enter the market? So before I joined Betterment, we were doing that. And then we found out from regulators that made us an alternate trading venue and and subjected us to a lot of regulatory surface area that we were not totally prepared for. So that got shelved and is on the back burner for a little bit. Yeah. But,
so what is your execution platform then?
So we have our own trading desk, and then we are executing through Apex, who also clears for us. Apex?
Okay.
Is there anyone over here? Been looking
You
this way.
You charge just the investment fee, flat fee. You don't charge transaction cost fee.
That's correct. Yeah, just the flat platform fee. No trading fees.
On all assets, you don't charge transaction cost.
That's correct.
On any.
Correct.
So how do you deal with customers who want to trade bonds a lot? Right? They're very expensive. They potentially could.
Well, they're bond ETFs first, so that's not super expensive. I mean.
So you don't transact with individual bonds?
No, it's all ETFs. Yeah. Yeah. Yep. And people are trading fairly and free. Like, it's not like a brokerage platform. You're like, I want to buy this, I want to sell this. Like the way that trades happen is either we're rebalancing for you, or you're telling us that you want a different allocation. We have to trade to get you to that different allocation. So, trading's not happening all that frequently because of that. Yep.
So with asset classes, when you say asset classes, it's ETFs in different asset classes. It's nothing else. So it's equities, basically. Securities traded on public exchange.
The vehicle is an ETF. The underlying economic exposure would be bonds or whatever. Yeah.
Okay, that makes sense.
Tax-wise, these are bonds, even if it's an bond ETF.
Yeah, because it passes through, right? So if your fund is all holding bonds, like you get the tax treatment. So it's confusing because we'll have a bond fund and it'll pay you a dividend. And what's that dividend is the coupon payments from the bonds inside of it. But that dividend you got from bond fund is treated like bonds.
So your tax savings you show is net of the fee of Betterment, or?
Yeah. Oh yeah, we do. Yeah. We're aware. Everything is net of Betterment's platform fee. Yeah. Anything over here, guys? No.
So when you measure actual return versus expected return, how is that actually calculated and tracked? Because you show the graph where your expected return is always higher than benchmark, or is that because of the tax saving, or do you see anomalies in actual returns versus expected return?
Yeah, it depends on what you're like. They're two different worlds, right? Expected return and realized return. So some of the stuff was realized return, some of it is simulation, some of it's expected. So it depends on which thing you're looking at. Yeah. All right. We can chat more though. Yeah.
大家都有排的，我你他妈排最大，我
Yeah, so like 20 days, 20 days ago, was your unrelated index twice by like a percentage of your time. It's good to draw down. Yeah, sure. So for portfolios, we don't like this independent selection process. We do have a smart beta portfolio that we built in partnership with GSAM. I think it's Electron.
I think she encourages strongly
Allocation and the fund.
but I actually don't.
Like on our platform, but for the models that are in-house, like
Yeah. But I actually think it'd be a good networking group. Like so many big.
No, thank you.
Oh,
yeah. Thanks for the question.
Yeah.
Yeah, they have this like you're in 100 and you're 80.
Good. Short answer is good. No, it's good. Like I would say compare and contrast. One, like the lifestyle is very different. Like,
Now if they did it daily,
it's more relaxed environment. But I would say that the most meaningful, there's two meaningful things that for like one is Betterment is much more mission. It's a lot easier to wake up every day knowing that the work I'm doing is helping like hundreds of thousands of people. Measurables. Like previously I was trading like products and like not a lot of steps you have to take to include people in the world. It's a few more, right? Like I was able to get there, but it took a little bit, right? So it feels a little more direct. And then the second piece is I don't think you could get one like I done there. I work very closely with designers, product people, and engineers. So very different set of people I work with than in the bank where you're working with people with very similar backgrounds. So, and at Betterment, like we're trying to hire the best designers. But you have to get about finance so that means that Mike and one, I'm interacting with people that are like great designers or great engineers or great product people, and I take a lot from them. Just like I really enjoy that, right? You know, the flip side of that coin is like we don't just backgrounds, we don't share the same language. So like sometimes it can be a little more challenging. It's like the days on the curve. You know, designer not know the first thing about Apple asset pricing model, right? And the designer's probably thinking the same thing to me. I've been this idiot doesn't know the first thing about design principles, but like, you know, I think like overall it's a process.